The whole concept of getting carbon offsets, carbon credits, hinges on the ability for them to be validated. And validation needs to happen through an independent third party for them to actually have real value.
Have you ever wondered what it takes to successfully raise money? I have worked with hundreds of capital campaigns across dozens of industries, and I'm here to share with you proven methods for raising money in record time and at the lowest cost, while also obtaining capital at the lowest price. My name is Carl Dakin, and welcome to Motivated Money. So hello, this is Carl Dakin with Motivated Money. This podcast is all about raising capital, and we're going to talk about how we can do that easier, quicker, cheaper, and maybe even reduce the price of money. So with that today, my guest is Eric Hanson with Mania. Eric's going to share with us a little bit about his new project and some of the challenges that he is currently looking at in the design of his capital campaign. And in particular, we're going to focus on the question of how do you structure a deal? And so we'll get into that more in a moment. Now, back to the Motivated Money, just to give everyone who's never watched or listened to this podcast before a little background. This is an approach that I developed over 4 decades of working with startup businesses on how to raise capital. And what it does is it points to people who are stakeholders as people who are more likely to invest than a common investor because they stand to benefit from the success of your organization. And because of that, then if they decide to make an investment, they have 2 benefits that they're going to get out of your success. And this combination means that they are more likely to make an investment than someone who only gets a single benefit. So for those of you who have been out talking to wealthy individuals, angel investors, venture capitalists, and so forth without success, we're going to be talking about a group of people that you may not yet have identified, stakeholders, and we're going to be talking about why they would be more inclined to invest. And for today's topic, where we're talking about structuring a deal, once you know who that stakeholder is, once you understand how they can benefit from your success, you have the opportunity to craft and tailor your deal to focus on each type of stakeholder there is. So you may find out you're not going to create a single generic one-size-fits-all type of an offering. You may find out you're going to do 2, 3, 4, or as many as 10 different offerings, all pointed to different people. But as you do that, you are tailoring those deals so that when the person receives it, they're going, they're talking to me, they are talking about me, they understand why I care, and they're trying to help me as much as I can get as much as I can get out of this deal. So this tailoring takes place within the structure of the deal after you know who you're going to talk to. It can't happen before because you don't know how to put together a deal for someone you haven't met yet or don't understand why they would want to invest in your company. But this then follows throughout the entire capital campaign design and development process. So first I find out who I want to talk to because they're most likely to invest. I'm going to structure the deal so it's very attractive to them. I may be able to modify the deal and amplify the benefits to the people I've identified. And then I'll put together all my promotional documents, the offering memorandum, the slide decks, all of these, and they're telling the story for that particular person. And then when I pitch, I'm going to be using the words, I'm going to be talking from the perspective of the investor. Here's why this is good for you. I won't spend my entire time talking about why it's good for me because at the end of the day, that's not going to drive the investment decision. So with that, we're going to talk now with Eric Hanson of, I'm going to pronounce this again the hard way, but Mania. And Eric, give me a little background on who you are, and then let's dive in and talk about your new project.
Excellent. Yeah, Carl, thank you for inviting me on your show. I have been an independent business owner for the last 40 years. I started out doing options trading, that kind of thing, started a company doing that, sold it, went on into the telephone business, started a little telephone company, did it all on scratch, sold it. Then I went up to North Idaho and took over a small pellet mill operation making wood pellets, grew that to doing well over 30 ton an hour of pellets from when I first started with the company. When I bought it, it 4 ton an hour, and got out of that. And now I'm starting a company called Mania. And Mania is not your typical for-profit firm. What we're looking at is using nature to help us sequester carbon. And how you do that is through the introduction of biochar to the landscape to create carbon sinks. That would be our phase one of what we want to do and what this money raise is all about.
So Eric, for those of us who may not be up to speed on that, first off, talk to me, what is carbon sequestration? What does it mean? What's the value behind that?
So carbon sequestration has multiple benefits throughout multiple food chains. More important for us humans and the planet itself is we want to capture carbon in the atmosphere and relocate it into the soils. By relocating into the soils, plants actually can be, you can take soil that is currently overly degraded, overused, and you can re-energize it. So not only do we have a direct impact on global warming, but we take forest land and or other property that currently is unusable maybe for food production because we've misused it so much, and we can return it back into production. So biochar is not new, by the way. Biochar was used in Mexico back in the Incas' time. You know, this is thousands of year old technology. So we're not talking about reinventing the wheel. What we are talking about is making the production of biochar, making that economically and commercially feasible. That's really where we're headed.
So what is biochar?
Biochar is a process by which you take biomass and you put it under low heat, low oxygen, or high heat, low oxygen, or you burn off all the volatiles of the product, and you're basically left with carbon. And that carbon's value is based on how, for lack of a better word, how porous that carbon is. In other words, how many open spaces that carbon now has in it to where it can actually capture things. So it's biomass that has been turned back into carbon.
So is biochar the same as or similar to a charcoal briquette that I might use on my barbecue?
No.
Okay.
So the charcoal briquette in your barbecue is, yes, it's made from typically wood. It is then has added a lot of additives put to it. But more notably, it has petroleum products and things like that. So if you were to take your charcoal briquettes and you were to crush them up and put them in your garden, you would kill your garden, most likely.
Okay.
It wouldn't survive. But if you were to take lump charcoal and then you were to put it in a barrel and reburn it in a oxygen deficient atmosphere, in other words, you would seal it all up with only allowing a tiny bit of oxygen into it, and then you could make biochar. I don't know what the quality would be, but that's generally the purpose. And then after you burned off all the volatiles, you'd be left with biochar, which then you could put into your garden, which would assist your garden in being able to hold water better, and not more important, be equally as important, you'll be able to hold the nutrients better. So your plants then have something that they're going to extract out of that.
Okay, so you have been working on a business model that is to make this all economically feasible. And that business model then is going to need an infusion of capital in order to get the ball rolling. And we've been talking about what would this deal look like? So a very common type of offering model, probably the most common ones you would see out there, would be you'd say you do a cash flow projection, you anticipate you're going to make so much profit over time, and you agree to give up a percentage of those profits to people who invest in your company, and that percentage of profits would take the form of equity or a revenue share or something of that order. So is that what you're going to do?
Similar to yes and then no. So what we did is we went out and we created a thing called the CO2 coin, which is a form of cryptocurrency. Then we're going to take the cryptocurrency and we're actually doing exactly what you talked about. We're going to turn that crypto coin, the CO2 coin, into a security. We're going to securitize it. That's where it turns into what you're talking about. And that is you end up with this coin, which would be a digital security. And we're going to take that digital security and we're going to market the digital security, which will have an equity basis in Mania. And depending on who you are, how much you invest, and what your needs are, that may actually entitle you to multiple benefits.
Yeah, let's stop at this point and make some observations for people who are listening in. So you're talking about creating a coin, and automatically everybody starts thinking in terms of cryptocurrency. And we are going down that path, but you made one critical distinction here, is that this is not a coin with nothing behind it, no assets, no value. It's got, in this case, it's being backed up by the future profits of your company. So in many ways, this is no different than getting a stock certificate and making it look like a coin and calling it a coin, because at the end of the day, holding the coin entitles the holder to have a share of the profits that you're making from your operation. That makes it radically different than cryptocurrency, which is made out of thin air with nothing behind it and no real justification for why there is a change in value. Those who know me know that I continue to challenge cryptocurrencies that are not backed by assets, because they have no merit other than a market phenomena which could disappear as quickly as it was created. So how are you going to make a profit from your company? What is the business activity that you're going to do? Because I know it deals with carbon credits and it deals with biochar manufacturers. So if you could explain what are the activities that will generate the profits?
That's a great question. Thank you very much. So what we're going to do is we're going to raise money. We're going to take that money and we're going to put it to work into either new technologies and or existing companies that are in the business of sequestering carbon, but they can't get the money themselves. So we think of us as a private fund that's going to go out and invest in these technologies and companies. These companies or technologies, by the very nature of what they do, create tax credits, carbon credits, and profit. So when we invest in a company, we will not only get a portion of their equity, but we're going to get a portion of their carbon credits and tax credits. So once we get the carbon credits and the tax credits, we'll verify those as being legitimate, and then we'll offer those to sale at a discount to our coin holders, if in fact they need those, because we anticipate that our coin holders or owners are one of their reasons for doing this is because they want to have an easy way of identifying legitimate carbon offsets.
Okay, so now we've reached a critical point in the design of your deal, because as you just described it, if you create a fund And the purpose of the fund is to buy equity in other companies. Then at that point in time, you're going to fall into a different class when we talk about securities regulations. You may be viewed as an investment company, you may be viewed as a private equity fund, and so forth. And all these things mean that there may be limits upon what you can do. There may be certain things you have to do from a reporting and information collection standpoint that you might not have to do if you did things differently. And this is going to be one of the, I'll just put it right out here in front, say, here's one thing we're going to have to deal with in trying to structure the deal, because it may be possible that you could put money into these companies in a way that does not take equity from the companies. Maybe you buy a technology and license it to the companies for use. And because you went to licensing instead of purchasing equity, it moves us out from being a security to a technology transaction, which may not be regulated at all. So we want to look at how do you put the money to work, and what do you get back for that, so that you may still decide, I still want to be that. I want to be an investment company. I want to be a private equity fund. Great. What can you do, not do? Is that going to handcuff you or limit what you can do? Or do you want to go about it in a different fashion? This is what we do when we go through deal structuring, is we go, okay, this is where I want to get so much money in or so much capital in. Okay, when I receive it, what kind of obligation am I going to have to the investor? And if you are acting as a pass-through vehicle where you're taking their money and you're putting it into yet other companies, the feds and the state securities people are saying, well, now you're a money manager. And you basically, you're making investment decisions on behalf of these individuals or organizations who invested in you. And that puts you in a different group under a different standard, and you're going to have to conform to a greater set of rules. And it's a general guideline, but it's not true all the time. But general rule is don't take on more regulatory pain than you need to. So I want to go back to then the cryptocurrency thing. So because again, this is an area that is getting great scrutiny right now. The whole cryptocurrency industry phenomena, such as it is, the regulators are concerned because people have abused the system. They've used it for money laundering. They're trying to use it for evading taxes and things of that order. And so everybody's anticipating we're going to see a whole bunch of new rules and regs coming down the pike that are going to make it much more difficult, much more expensive to facilitate the creation, transfer, and use of cryptocurrency. And in fact, there was one set of talk that came out last week that anyone who touches that transaction, which could be a lawyer, accountant, the banker, or someone else, might also fall under these same rules, which would be the similar if you were a currency trader or someone who does nothing but move money back and forth. And similar to the conversation we just had on, you want to be careful in structuring your deals so you don't gain more regulatory burden by being a pass-through or money management type of entity. In this case, you also want to be careful that you are not viewed as basically a currency transfer point, which will be subject to yet other sets of regulations and more bookkeeping and more compliance kind of things. And so as you're looking at this and you're saying, okay, we want to give a benefit back to your investors, giving them a discount on the carbon credits. You're going to be distributing profits to them based upon their equity holdings. This is something that will have to be looked at, because if you commit to it in the offering document, then it's a contract with the investor, and you're going to be asking yourself, do I need to do it this way, or is there a simpler fashion for getting these rewards? recognizing that you've used your investors' money, you want to give them a share of all the benefits that come out of that without necessarily getting wrapped around the axle with yet one more set of regulations. So do you have some ideas on how you're going to facilitate the buying and, if any, the buying and selling of your coins after they're made?
Yeah, so we're entertaining the idea of actually doing a 506c offering under Reg D of the SEC rules. We're going to comply with all of those security requirements. So one of those requirements, and what's interesting or appealing to us at the moment, and as you said, that could change, is the 506 allows us to raise money from accredited investors only. Okay. Some people think that that's not so good. I think at this point in time, that's a good thing, because we don't want to bring on people who could be assumed to not understand what they're investing in. So that's one of the regulatory paths we're heading down. And then the only reason let's go back to crypto. The only reason why you would do an offering like this as a cryptocurrency is because once the crypto is issued, it is liquid. It's a liquid transaction, and the exchange can monitor who and who cannot buy or sell that crypto. Let me give you an example. Once we put this out to be sold in the initial private offering, the exchange, the crypto exchange, looks at this person, validates that in fact they're an accredited investor, puts all of the documents together, and then only issues them their initial cryptocurrency in a wallet controlled by the exchange, because you can't allow people to immediately sell the coin. Okay.
Well, yeah, and we don't have time to go into the 10 questions you just you just put on the table, because I'm going to say I'm going to get a little defensive here and go, I wouldn't call it liquid yet, and the liquidity is a term that some people may not understand, but it means that once you invest in something, that you have the ability to sell that investment. And if you happen to buy a stock on Wall Street, a fully registered, publicly traded stock, you can buy it today, sell it later today. Day trading, that's what that refers to. If you get into real estate, you buy it today, you may not be able to sell it for a year or two or more, because there are no buyers standing ready. There is no marketplace ready to acquire that. What cryptocurrency has tried to achieve is to say, if I buy into a private company like Eric's, and for whatever reason I need to cash out tomorrow, I have a call on my money for an emergency or something else, is it going to be easier for me to sell my ownership in that company? And that easiness is dependent, though, upon an exchange being willing to act as a market maker in that coin. And that's not a guaranteed thing. So when you say it's liquid, I'm going to say it's potentially liquid, and say that's one more thing that becomes a what if or maybe not question for an investor to consider when looking at getting into cryptocurrency. So with that, you also raised questions. We got into the definition of accredited investors, and we've talked about 506c offerings. I will just tell you that each of these topics will be discussed in more detail in a future episode of Motivated Money, because those people who are raising capital, these are important concepts to understand and to master if you're going to go out into the world and start looking for capital. It's very, very important to know that there's a limit there, or a line you cannot cross, or if you cross it, it's going to cause consequences that you may or may not want to deal with. Eric, it sounds like you've got a really cool, though, business model where that you take the money, You're going to facilitate biochar are being manufactured and applied and used, which can result in the generation of carbon credits, which itself is not a certainty. Is that correct?
That's absolutely true. So the whole concept of getting carbon offsets, carbon credits, hinges on the ability for them to be validated. And validation needs to happen through an independent third party for them to actually have real value. So in that, part of our business plan is to team up with the Colorado School of Mines, and in fact, it's part of our proposal, Colorado School of Mines, who are going to, for a fee, by the way, write the protocol, procedures, and verification systems so that we could take our created credits and show to, like, the state of California, show the state of California, yes, these are valid. They've been independently tested and verified by people who at least should know exactly what they're talking about.
Right. So as listeners can tell from this description, we now have a business model with like 3 key elements in it. And each of those elements need to be analyzed in terms of what this may do or what impact it may have on the deal. And so as you're crafting the offering, you're going to say, I'm going to give you this and you're going to give me money. You're going to have this clear as possible. You're going to have to be able to translate, communicate it so that the person who's the potential investor can understand it. And then you're going to hope that this isn't so complicated that it spooks them or that they can't wrap their mind around it and they can't make an investment. This becomes a challenge to the person who's raising the money to make this all crystal clear. As I challenge everybody, smarter than a 5th grader, don't laugh at that too much. You want to really make this simple so that the person who's making the decision is fully informed. They can get once fully informed, they can wrap their mind around it to the point they can get excited about making the investment. In this case, this is a very strong environmental help play, and it would give people a chance to help the environment while also potentially making a return on their investment. And then going back to the motivated money approach, if we go to the common investor, the one who's only looking at return on investment, we may find a lot of them consider this investment to be less than or equal to a lot of other things they're looking at. But if you take this capital campaign to people who care about the planet, who understand sequestration, who don't need to be educated on everything we've just been talking about, it'll make your capital campaign ever so much easier. And that's part of what we try to teach in the motivated money approach is you don't have to sell to everybody. You don't have to be satisfactory to every potential person who could be an investor. You just need to get your story told well to the right people in a large enough quantity that you can get your capital campaign completed and you're done and you can get back to your business, which in this case is saving the planet. So with that, Eric, I thank you very much for being a guest here today on the Motivated Money podcast. This episode just illustrates how as you're working your way through designing your capital campaign, this step in the process, which is structuring your deal, is very, very important. It's important in terms of what is it you're doing, but also what consequence or how it may impact who you can raise money from, how much money you can raise, what kind of regulation may be imposed upon you, and regulations cost money, which all removes profits from the bottom line. So we're gonna come back and talk to Eric here in the future. I want to see where he is here in not too distant future. Once this deal is solidified and he has his message polished, so that when he talks to us, everybody goes, man, that is so cool. I get it, everything. And he's minimized the regulatory structure that may follow this. So thank you all for today. Those of you who like to do homework with every episode of the Motivated Money podcast, what I would ask you to do is sit back and think about who you're going to talk to as an investor. Think about what kind of a deal, what offer you would want to make to that person that's going to cause them to make a favorable decision on your behalf. And then play with it in terms of how can you tweak it, how can you remodel your offer so that it's easier to communicate, it's easier for somebody to appreciate. It's also going to cause you less brain damage as you try to work your way through the regulatory structures, which may not be limited just to securities or currencies. It may get into, as Eric was talking about, you've got carbon credits. Somebody's got to sign off on those to verify that they're real and they meet the test for whoever is buying those carbon credits. So there are layers here of different people, outsiders, who are going to control and influence your business. And as you're putting together your offering, you need to think of all those people because they are, in fact, also stakeholders in your success. So with that, Eric, thank you today. We'll say good day for this episode. And I appreciate you being on the program here today.
Okay, thanks a lot, Carl. It was a pleasure.
Thank you for listening in to Motivated Money. If you like this or any other episodes, make sure to leave a rating and review the show. We love to hear your feedback and want to make this the best possible show for you. Also, if you like this episode, make sure you share it with someone you know who is seeking to raise capital. They will appreciate learning what you now know about raising funding. I'll see you on the next episode of Motivated Money.